Welcome to the two-part series of discussion on the two major types of business transactions that occur, asset and share deals. Let's first talk about the asset deals. From a buyer as well as from seller's perspective, there are a number of very distinct advantages, disadvantages, and particularities in regards to the asset deal. Generally speaking, when you do purchase assets from an existing corporation, you either come in as a buyer with an existing company that will be purchasing the assets of the business, or you set up a business corporation that is specifically put together for the acquisition. Either way, you are then purchasing the assets of the existing business. Those assets including the tangible assets, including inventory, fixture, furniture, equipment, but also all the intangibles that go in the business, including brand name, logos, telephone number, client list, etc. When a buyer performs an asset deal, there is a little more work that needs to be done pre-closing, meaning that the buyer needs to make sure that to the best of their ability they assure the uninterrupted transfer of contracts, employment relations, lease, as well as any other existing vital for the business operation tasks. In that regard, we are seeing that whenever an asset deal happens, the pre-closing is a little bit longer, but what happens then is that once these things are all checked off, the closing of the transaction is really a formality, because there is a very clear stoppage of liabilities and responsibilities between the two businesses, and the buyer is really not all that concerned about finding every single thing about the existing corporation that they purchased the assets from. As long as they purchase the assets free and clear, as long as they assure the uninterrupted continuation of the business, then we are ready to move to closing, which, as I said, it's a much quicker one. The one other aspect that I would like to discuss in regards to an asset deal is very quickly touching upon the tax implications of it. With the caveat that obviously we are not experts in taxation, every tax situation is different, and the buyer and the seller need to have their own advisors in that regard. However, what I can tell you immediately in regards to an asset deal is that one aspect that becomes immediately in play that has tax implications to both parties is the fact that the seller cannot in an asset deal take advantage of the once in a lifetime capital gains exemption that they could possibly be entitled to in a share deal, and two, there is a resetting essentially of the balance sheet, meaning that the existing corporation of the seller sells all the assets to the buyer's corporation, but then there will be some negotiations going back and forth in terms of what the value of the assets being sold will be on the books of the buyer's company. That is usually because the higher the value of the assets on the purchaser's company, the higher or the better the tax shelter that it can provide in terms of future depreciation for the buyer. As far as any other important aspects of the asset deal, there are certain things that the buyer needs to be aware, including the fact that opting to do an asset deal, they might be getting into a little bit more prolonged negotiations or prolonged transfer of the lease, since, for example, when a new company is set up, doesn't have any credit history, a new buyer comes in and tries to do an assignment of the lease, the landlord, for example, could be a little less amenable to doing that. Another important aspect of it is dealing with employees whenever an asset deal is being done. This goes into a whole other level of discussion that really is governed not only by the standards, Employment Standards Act, but also by the agreement that the existing seller and buyer are able to enter with the employees. But keep in mind that when you purchase assets of a business and when you set up a new corporation to do this, you will essentially need to enter into new agreement with the existing employees, and there will be much more of a chance and a possibility that some of the employees just opt out of discontinuing to work with the new company and the new owner, as opposed to in a share deal where, when done properly, there might be very little red flags to the employees, and they might not even know that a change of control has taken place. This is, in a nutshell, a couple of the important aspects of it. So to summarize again, asset deal provides very clear stoppage of responsibility and liability for a buyer. It takes away the advantage to the seller to take of the $750,000 capital gains exemption. It provides for a little bit more work in terms of making sure that the transition is done properly, and obviously triggers some discussion and negotiations in regards to resetting the balance sheet in purchasing the assets at fair market or any other negotiated value, as well as bring some discussions in regards to the way that the employees will be handled in such a transaction. So hopefully that gave you a little bit better idea of what the asset transaction is. And in the next part, we'll discuss the share purchase and the share deal as an alternative, and discuss some of the differences between this one and the share purchase. Thank you very much, and hope you enjoyed it and found it informative.